Hey, welcome back. Here is something wild to think about. Every single Bitcoin transaction since January 2009 is still sitting there, permanently visible for anyone to inspect. Not summarized, not estimated, the actual raw data. That means you do not have to guess what Bitcoin holders are doing. You do not have to rely on a survey or an opinion poll or a guru on social media telling you what smart money thinks. You can literally watch the behavior of every single coin in existence. Most people never use this. They look at the price candle, feel an emotion, and make a decision. Meanwhile, there is an entire layer of objective data sitting right below that price chart, quietly telling a much more complete story. This is called on-chain analysis, and today I'm giving you a clear, practical breakdown of the metrics that actually matter. Not a long list of confusing jargon, just the specific tools that tell you what is genuinely happening with Bitcoin supply, demand, and holder behavior right now. By the end of this video, you will know exactly what to check, where to check it, and how to read it like someone who actually understands what is happening underneath the price. Let us get into it. Active addresses, the pulse of the network. Let us start with the most basic and intuitive metric, active addresses. Active addresses count how many unique wallet addresses are sending or receiving Bitcoin on a given day. Think of it as a heartbeat monitor for the network. It tells you how much genuine activity is actually happening, separate from whatever the price is doing. Here is why this matters so much. Price can rise on thin trading and low genuine usage. That happens regularly during speculative spikes. But sustainable, healthy growth in Bitcoin's value has historically been accompanied by growth in actual network usage, meaning more people are genuinely transacting, not just a few large holders pushing price around with low volume. When active addresses are rising steadily alongside price, it tells you the rally has real participation behind it. More people are actually using the network, not just watching the price go up. When active addresses are flat or declining while price continues rising, that is a warning sign. It often means the price increase is being driven by a smaller number of large transactions or by derivatives and speculation rather than broad organic demand. This kind of divergence has historically preceded periods of weakness, since a rally without real participation tends to be more fragile. The reverse pattern matters too. During bear markets, watch for active addresses to stop declining and begin stabilizing or growing again, even while price is still low or falling. This is often one of the earliest signs that genuine interest is returning to the network, before that renewed interest fully shows up in the price. You can track active addresses for free on Glassnode and several other on-chain dashboards, usually shown as a simple daily chart you can overlay directly against Bitcoin's price. Realized price, the network's true cost basis. The next concept is one of the most powerful valuation tools in on-chain analysis, realized price. Here is the simple version. Every Bitcoin in existence was acquired at some price, at some point in time. Realized price calculates the average of all of those purchase prices across every single coin currently in circulation. It essentially tells you, on average, what the entire market actually paid for the Bitcoin it currently holds. This is fundamentally different from just looking at the current market price. The market price tells you what Bitcoin is worth right now. Realized price tells you what people actually paid for it, on average, across the network's entire history. Why does this distinction matter so much? Because comparing current price to realized price tells you whether the average holder across the entire network is sitting on a profit or a loss. When Bitcoin's market price is significantly above the realized price, it means the average holder is sitting on substantial gains. This condition has historically appeared during the later, more excitable stages of bull markets, when the temptation to take profit grows stronger across the holder base. When Bitcoin's market price drops below the realized price, it means the average holder across the entire network is sitting at an unrealized loss. This is a historically rare and significant condition. It has only happened during the deepest points of major bear markets throughout Bitcoin's history. And in every previous instance, this condition has coincided with periods that, in hindsight, represented exceptional long-term buying opportunities. Realized price is not just a number. It is a line on the chart that has acted as a powerful psychological and structural support and resistance level throughout Bitcoin's history. Price spending extended time below realized price has historically been rare and short-lived, while price has repeatedly found strong support exactly at this level during corrections within ongoing uptrends. You can view Bitcoin's realized price directly on Glassnode, typically displayed as an overlay line directly on the price chart for easy comparison. Supply in profit versus supply in loss. Building on the realized price concept, the next metric breaks this down even further. Percent of supply in profit versus percent of supply in loss. Instead of looking at just the average across the network, this metric calculates coin by coin what percentage of the entire circulating Bitcoin supply is currently held by someone sitting on a profit and what percentage is held by someone sitting on a loss, based on the price at which each individual coin last moved. This gives you a far more granular and behaviorally useful picture than a single average number. Here is how to use it. When the percentage of supply in profit reaches extremely high levels, typically above 90 to 95%, it means almost every Bitcoin holder in existence is currently profitable. While this sounds purely positive, historically, these extreme readings have coincided with late cycle euphoria. Since a market where almost everyone is sitting on significant gains creates enormous collective incentive to start realizing those profits, which can become self-reinforcing selling pressure. When the percentage of supply in loss reaches extremely high levels, it indicates widespread pain across the holder base. The vast majority of coins are underwater relative to their last purchase price. Historically, these conditions have appeared during capitulation phases near major market bottoms, representing periods of maximum collective pessimism that have, in hindsight, frequently marked excellent long-term entry points. The practical value of this metric is that it shows you the emotional state of the entire market in a quantifiable way. You are not guessing how people feel based on social media sentiment. You are calculating, mathematically, exactly how many people are happy with their position and how many are not, based on actual blockchain data. Watching this metric shift gradually over weeks and months, rather than reacting to any single daily reading, gives you a clear sense of where the broader holder base sits emotionally and financially as market cycles progress. Fuel multiple and miner behavior. The next metric brings in a completely different angle. Bitcoin miners and a specific tool called the Fuel multiple. Bitcoin miners are the entities that secure the network and are rewarded with newly created Bitcoin for doing so. Miners have ongoing operational costs, including electricity and equipment, which means they regularly need to sell some portion of the Bitcoin they earn to cover those expenses. This makes miners a consistent and somewhat predictable source of selling pressure within the market. The Fuel multiple measures the daily value of newly issued Bitcoin, meaning the dollar value of coins miners are currently earning compared to the average value of daily issuance over the past year. It essentially tells you whether miners are currently earning unusually high or unusually low revenue relative to their own recent historical norm. Here is why this matters for understanding market cycles. When the Fuel multiple is extremely high, it means miners are earning significantly more than their recent average, usually because Bitcoin's price has risen sharply. This often happens during late-stage bull markets. Historically, these elevated readings have coincided with periods where miner selling pressure increases significantly, since miners are incentivized to realize their unusually high revenue, which can contribute to slowing or reversing price momentum. When the Puel multiple is extremely low, it means miners are earning significantly less than their recent average, often because price has fallen substantially. During these periods, less efficient miners can become unprofitable and may need to sell existing reserves or even shut down operations entirely. Historically, these low readings have closely coincided with capitulation phases and market bottoms, since this represents a point of maximum stress within the mining industry that has historically preceded periods of recovery. The Puel multiple gives you a unique lens into market cycles, viewed specifically through the lens of mining economics rather than general holder behavior, adding another independent layer of evidence to your overall analysis. Putting it together, a simple weekly routine. You now have 4 genuinely useful metrics. Let me give you a simple, practical way to actually use them without becoming overwhelmed. Build a simple weekly check-in routine rather than trying to monitor everything daily. Once a week, check active addresses to confirm whether genuine network usage is growing, flat, or declining relative to recent months. This tells you whether real participation supports the current price trend. Once a week, check Bitcoin's price relative to realized price. Are you significantly above it, suggesting the market broadly is in solid profit and potentially approaching excessive optimism? Are you near or below it, suggesting the market broadly is near cost basis or at a loss, historically a zone of opportunity? Once a week, check the percentage of supply in profit. Is it at an extreme high, suggesting euphoria, an extreme low, suggesting capitulation, or somewhere in a more neutral middle range? Once a month, check the Puel multiple to understand whether miner economics suggest unusual stress or unusual excess in the current environment. This simple, low-effort routine takes maybe 15 minutes a week and gives you a genuinely informed perspective that the vast majority of price chart watchers never develop. Let me bring this all together. Active addresses tell you whether real network participation is supporting the current price trend or whether the move looks thin and speculative. Realized price tells you the average cost basis across the entire network, giving you a powerful, historically meaningful reference point for whether Bitcoin is cheap or expensive relative to what people actually paid. Percent of supply in profit and loss tells you the emotional and financial state of the entire holder base, quantified directly from blockchain data rather than guessed from sentiment. The Puel multiple gives you a unique window into miner economics and the selling pressure or capitulation that comes from that specific corner of the market. Here is the truth I want to leave you with. None of these metrics predict the future with certainty. Nothing does. But together, they replace guessing with evidence. They replace social media sentiment with actual blockchain behavior. And over time, that shift from guessing to evidence is exactly what separates investors who understand what they are holding from investors who are simply along for the ride. Bitcoin gave the world an unprecedented gift of transparency. Almost nobody uses it fully. Now you know exactly where to start. If this video helped you understand Bitcoin's on-chain data more clearly, please hit the like button and subscribe. Share it with someone who only looks at the price chart and nothing else. Drop a comment below and tell me which of these 4 metrics surprised you the most. I read every comment. I will see you in the next one.